Hello, in this video I'm going to analyze Sam's two trades that he took on the pound pairs today. Please subscribe to the channel and hit the bell icon so you get notification every time there's a new video. So he's taken the trades, but beautiful trades, lovely trades. The pictures that you see, one is here. First trade is on the pound dollar, which is a pretty good trade, and the other one is on the pound yen. So these are good trades, but he got an outcome which I am not quite happy with. Not that I'm upset with it or anything like that. I'm just saying, let's have a look at it if it could have been managed differently. So one is the pound dollar and the other one is the pound yen. I'm going to go to my chart, and so what we see here is the pound dollar. So what the pound dollar did was it kind of moved down yesterday, and then look at these candles, not candles. Look at these wicks, right? You can see that it's kind of an indecision, and then it goes up, but it doesn't go up far enough. It's immediately being hit by somewhere around this blue and red line intersection, around those levels, and it creates this bearish pin bar or a fruit candle, or just simply call it an indication that when market went up, sell orders took over and it started going down. And what follows is, this is basically the leading indication, these kind of candles. And so it's further went down, and during the later part of the day, which was off trading time, London was closed probably just towards the end of the US session, it continued to go down, and then it went sideways as expected during the Asian session, until when Frankfurt opens around here, it started to go down. So if you wanted to trade this and you took a trade here at this point here, what you have to realize is what has actually happened before it. So it's dropped 130 pips, and now if you go to multiple time frame analysis, let's go to the 4-hour chart. So what do we see on the 4-hour chart is that it's gone up and then it's created this ABC pattern. So it's a pullback. Could this be the C wave down? Yes, that is a possibility. Go to the daily chart, and what we see is maybe it is starting an uptrend. Maybe this is a pullback. Maybe it's not. But what you do see, this candle. So when I go to the daily chart, then I kind of restrict my focus on the chart. So if I'm looking at the daily chart, I'm not looking at all of the daily chart. I'm looking at these levels, whatever is, because my focus is on the hourly chart. And then I want to see the price action of the hourly chart within a daily chart. So that's all that I'm concerned with for now. This level I'm concerned with, this level, right? This level could be something as well. If I go to the 4-hour chart, then I can see all of these levels are my levels. Now if I go to the hourly chart, I'm taking this trade, what do I see? I clearly see this, and specifically this level. Why? Because as you can see, there's this strong reversal candle here, and then it's proven itself because price actually did follow after that and went up. So if this appeared and then price went here and went down, then this wouldn't be that strong a level for me. But for this becomes a strong level. So, and for the same reason, this would be a strong level as well for future. And this is also a strong level. As you can see, there's a reversal candle, an outside candle. Price actually follows through, goes up, hits those levels, then drops. As you can see, when it hit it here and then hit it again, it actually dropped fast. Now coming back to Sam's trade. So Sam takes a trade. This is essentially an M15 trade, right? You see a 1, a 2, a 3, a 4, and a 5, as you can see clearly. I'm going to start and put my target zone using the start of wave 3. Comes here. Okay, it has not hit target zone 1. Fine. If you take a trade here and you need a 10 and you use a 30 stop loss, that's going to be difficult. Why? Because your target zone is about 37 pips away from you. So how do you make a decision of taking this trade? Well, if your target zone is 30 and your stop loss requirement is, let's say, 27 or 28, then that is just a 1 hour trade. So essentially you can actually filter this trade by saying I don't have sufficient reward available for the risk that I'm taking, because it needs to be 1:2 or 1:1.5 at least. Another way of doing this is that if you wanted to go short here at the London Open, you would go short below this level and have your stop loss at 15 up there, up here or up somewhere there. Reduce it, because if the market was to hit your sell order and then go back up, you're not interested in it. In that case, you would be closed out for a loss. So let's suppose you took a 15 pip stop loss. Around here, you were almost near your target point. Still a pity that it wouldn't have gone, but you would still have taken at least half the profits at plus 15. So that would be one way of managing it. The way he managed it, it came down, went up, break even, nothing wrong with that. But I think I have a problem with the idea of taking the trade where you can clearly see you only have 1 hour available. Let's go to the next one, which is the pound yen. So the pound yen has a slightly different issue, because so we know that the pounds are going down, but the yens are going up. Let me show you that. So, well, not the yens are going, the yens are losing value. So because of that, the euro is going up against the yen on the hourly time frame. And let's go to the dollar yen. You can see even on the dollar yen, in the last 2 days, it has been going up against the yen. So that was against the pound yen, but looks like the drop in value of pound against the yen is actually stronger than this comparison. So if you go to the pound yen, as soon as you can see that dollar yen has kind of paused its upward movement and the euro yen is pausing, this has now allowed pound yen to continue going down. But in a situation like this, you have these opposing forces on 50% of the Forex pair. So when you trade Forex, you always have to think in terms of two currencies, because every time you trade, you're actually trading two currencies. One is dollar, which is the base currency. Whether it's a base or not, it is a currency. It has its own demand and it's got its own supply. As we know, there's a lot of supply these days because they are printing it. Anyway, that's a different thing. So from that point of view, if you went to this, if you saw this chart on the hourly, you want to be in from here, not here. If you took this based on the M15, then we will drop to the M15 and look at it from that point of view. Again, similar situation, as we can see, a 3 down, a 4 up. I will bring my target zone and I will analyze that to see what is my potential of a trade. So my potential here, if I make an entry here, my target is 40 away. My stop loss is 30. Again, it's not a 2R, but I can use the trick of, say, 20 stop loss, because just above this dot candle, and I'll bring it to break even, and if it goes to 2R, fine, otherwise I'll go out. So again, Sam has done the right thing. He has taken the trade and he exited at break even. Even if you use the trick of, let's say, 15 stop loss on this, you would just have gone near your target point of 30, but then it snapped back at you. I wouldn't recommend looking at the M15 chart all the time with every candle. In fact, that's the beauty of AIMS stress-free trading, is that you take a trade here and you have this, you can use any trade manager, but the one that we like and we use and we recommend is Snorm's Advanced Trade Manager, which is, the main reason is that it was designed not particularly for us, but with a great bit of input from our side. So Steve has been kind enough to compensate the needs of the AIMS traders into it. So that's why you have the buy, swing, and sell. So it's been a collaboration. Most of the work Snom has done. I've only provided input and used it and tested it to my advantage. So I'm more grateful to him than he can be to me. So if you want to invest in this, please do so. I'll put the link in the description. But this is what we use. I would have coded one for me for the AIMsters, but we don't need to, because Snorm's Advanced Trade Manager does work. It's pretty good, and we use it. So if you were to take a trade here and your stop loss was there, and when this goes on, you just leave the screen. Or if you have your charts on the platform on the VPS system, then you can just take a trade and just leave, because your trade management plan, listen to this carefully, your trade management plan is encoded into this. When you press those few buttons and stuff, it's there, and once your trade management has been coded, you don't want to touch it. And that is the key idea of trading. Once you make a decision and your plan, and you've tested it and you know that this plan works, you don't want to mess with it, because if you mess with your trade management plan with every trade, then your statistics are going to be incorrect. So you won't know at the end of, say, 20 or 30 or 100 trades whether it was you who broke the laws, it was you who lost the money, was it the market that was too bad, or the third factor, was it the system that did not work? So you have to be aware of these things. So the first thing is you want to be disciplined, and for that, that's your part of the deal. The other one is you need to have a strategy, which we give you. So you have the strategy that works. It's been time tested. It's not originally a strategy that only I made. It was already there, already successful. We modified it and make it, if you allow me to say, made it a lot better than it originally was. It works for us. It will work for you. When you take a look at it, you can backtest it. Nobody's asking you to trade, and never actually do that. If you ever buy or make your own, or somebody gives you a strategy, you don't just want to trade it straight away. You want to understand it first, and the process of understanding is to actually read about it, if there is material about it, watch the videos and stuff if there is about it, which we have, or other strategies if you are following those. Understand them, and then the most important thing is to have as long a back test as possible. And then the next step is demo trading. And if you are profitable on demo trading while you are being disciplined, there's another problem that comes to my mind, is that people do demo trading, but then during demo trading they're not following that strategy, because their inherent problem is discipline. So if you have a problem of discipline, it will increase in demo trading. And most of the traders have these two big problems, that they make very wrong entries, random entries. They don't make their entries based on the strategy. What they do instead is they just look at the price, and whatever they feel like, they start going long and short, and then sometimes with whatever they feel like, they exit their trades. And the second most important, actually this is the most important thing, is that people don't actually follow a risk management plan. So if you go into a demo trade and you don't follow risk management and you don't follow your strategy, then you are actually fooling yourself, saying, oh, I'm taking a trade, I'm demo trading, it didn't work. You'd say, oh, this strategy didn't work in demo, I'm not going to go for live. That's not true, because in demo there's another problem, that you are not scared, you don't have any fear of losing anything. So what you end up doing is that you're not even monitoring your progress, and you just randomly do this. So some people will just randomly make a lot of money, and then they'll say, okay, let's go to the real account. And when you go to real account, they stop losing money. Or the other people who make a lot, don't make money, they just miss out on the opportunity. They don't even go to the actual thing. So that's another thing that I wanted to talk about, and that's what it is. So this was analysis of Sam's trades. And hey, if you like the video, please hit the like button and subscribe to the channel. Make sure you hit the bell icon, so whenever there's a new video, you'll get a notification. I do send out emails to people who are on the list, or mailing list. So we send them a reminder to say, oh, there's a video out. If you want to have a look, go there. So if you'd like to be on the list, we have a little incentive for you as well. The link is in the description top. You can download my free book, 10 Seconds to Elliott Wave. It's on the screen. And that book explains this concept here, how to count Elliott Wave within 10 seconds. We are not Elliottians. We just use that concept. We understand that the market is a wave. We understand that Elliott Wave presented it pretty nicely, but we also understand that they did a phenomenal job and made it extremely intricate and difficult to read. But you don't need that difficult or really in-depth understanding of the Elliott Wave. What you need to know from our point of view, and it's my opinion, if you don't agree with me, that's fine. Wait for 3, wait for 4, trade that wave 5. That's what we do. See you in the next one.
Thank you for watching. I hope you liked this video, and if yes, please hit the like button. Do you have any questions or ideas for upcoming videos? then leave a comment. Also subscribe to the channel and hit the bell icon so that you never miss any future videos. See you next time.